take a moment and slow down for a second. Because something in the metals market right now doesn't quite line up with the story most headlines are telling you. As of this morning, silver is hovering near $84 per ounce, slipping slightly after the previous session. On the surface, the explanation seems simple. U.S. inflation data for February showed CPI rising 0.3%, exactly in line with expectations, yet still above the Federal Reserve's long-term target. That single number reinforced a message the market has been wrestling with for weeks. Rate cuts may not arrive as quickly as investors once believed. The U.S. dollar strengthened, Treasury yields pushed higher, and metals that do not produce yield naturally felt the pressure. But here's the detail worth sitting with for a moment. At the very same time, oil prices are climbing sharply as the conflict involving Iran spreads across key energy routes. And global institutions like the International Energy Agency are already discussing emergency releases from strategic reserves to stabilize supply. When energy markets tighten, inflation rarely fades quietly. It tends to echo through currencies, interest rates, and eventually the metals market itself, and that is where the real story may begin to unfold in the next chapter. Now let's stay with the inflation story for a moment, because this is the layer of the market that quietly shapes almost everything else. But here's the detail worth sitting with for a moment. At the very same time, oil prices are climbing sharply as the conflict involving Iran spreads across key energy routes. And global institutions like the International Energy Agency are already discussing emergency releases from strategic reserves to stabilize supply. On paper, that sounds stable, but markets don't trade on the present alone. They trade on what the next move from policymakers might be. And right now, the message investors are hearing from the Fed is simple: patience. Traders who once expected multiple rate cuts in 2026 are now pricing in only one potential reduction for the entire year. That shift may sound small, but its consequences ripple outward quickly. The U.S. dollar strengthened, Treasury yields climbed, and assets like silver and gold, metals that produce no yield, felt the pressure almost immediately. But here is the subtle detail worth understanding. Inflation driven by energy shocks rarely disappears quietly. Oil prices are rising amid the escalating Iran conflict, and global supply uncertainty is building across the Gulf. The inflation story may be far from finished. And if energy continues pushing the cost of everything higher, the policy decisions made in Washington could soon collide with forces moving far beyond it. Now step back for a moment and look at where capital is actually moving, because markets often reveal their priorities through flows rather than headlines. Over the past several sessions, the U.S. dollar has quietly strengthened, climbing close to its highest level of the year, while the euro slipped toward $1.15, reflecting a subtle but important shift in global sentiment. When uncertainty rises from inflation pressure, energy disruptions, or geopolitical conflict, capital begins searching for stability. And for now, that stability is being found in the dollar and in U.S. Treasury yields, both of which have moved higher as traders reassess the Federal Reserve's path. This matters for metals more than it might first appear. Precious metals like gold, near $5,150 per ounce, and silver around the mid-80 range, do not generate income, which means when yields climb, the opportunity cost of holding them rises. It becomes temporarily more attractive for global investors to hold dollars rather than bullion. Yet this shift is rarely permanent. Safe haven flows tend to rotate across assets as conditions evolve. And when geopolitical risk, inflation pressure, and monetary policy begin interacting at the same time, investors eventually face a deeper question. Not simply which asset is strongest today, but which one will hold value when the broader system begins to move again. But now let's shift our attention away from the metals screen for a moment and look at the market that may actually be driving the next chapter of this story: energy. Silver is hovering near $84 per ounce. Gold has slipped slightly toward $5,150, but the real volatility is unfolding in oil. Reports from the Middle East confirm that 2 oil tankers were set ablaze near Iraqi waters, part of a widening series of attacks linked to the escalating conflict involving Iran. Iranian officials have warned the world to prepare for the possibility of oil reaching $200 per barrel, a number that may sound extreme, but one that carries enormous implications if even partially realized. Institutions like the International Energy Agency have begun discussing coordinated releases from strategic petroleum reserves in an attempt to calm the market. Yet prices have continued climbing as supply routes across the Gulf remain uncertain. And this is where the broader economic picture becomes clearer. Energy is not just another commodity, it is the foundation beneath transportation, manufacturing, and global trade itself. When oil begins to surge under geopolitical pressure, the effects ripple outward into inflation expectations, into monetary policy, and eventually into asset pricing across every market. Which means the movements we are seeing in metals today may be less about weakness, and more about a system quietly recalibrating beneath the surface. Now take that picture one step further. Because the real tension in the energy market is not just about rising prices. It is about geography. At the center of this situation sits a narrow stretch of water the world has watched for decades, the Strait of Hormuz. Roughly 20% of global oil shipments pass through that corridor every single day, making it one of the most critical choke points in the modern economic system. And according to multiple reports, the situation there is becoming increasingly complicated. Iranian forces are believed to have deployed naval mines in the strait, a move that could significantly delay efforts to reopen the route fully. Meanwhile, several oil tankers remain stranded, as security concerns ripple across the Gulf. At the same time, producers in the region have begun slowing output, as storage facilities approach capacity, reflecting how fragile the current supply chain has become. For global markets, the implication is straightforward. Energy supply disruptions do not stay confined to the oil sector. They filter into shipping costs, manufacturing, and eventually consumer prices worldwide. That is why institutions such as the International Energy Agency are already discussing emergency responses. And if this corridor remains unstable longer than expected, the pressure building inside the energy market could begin reshaping inflation expectations and financial markets far beyond the Gulf itself. But what makes this moment even more revealing is how governments have already tried to respond, and how little the market seems convinced. In recent days, discussions have intensified around a coordinated release of strategic petroleum reserves, a mechanism that institutions like the International Energy Agency have historically used to calm sudden shocks in the oil market. The idea is simple. When supply becomes uncertain, governments release emergency stockpiles to stabilize prices and reassure traders that energy will continue flowing. Yet despite those signals, oil prices have continued pushing higher, reflecting a deeper concern among investors that the problem may not be temporary. The attacks on tankers near Iraqi waters, and the growing tensions surrounding Iran. These signals suggest a supply disruption that cannot be solved quickly by policy alone. Strategic reserves can buy time, but they cannot rebuild shipping lanes, they cannot reopen contested waterways, and they cannot erase geopolitical risk overnight. Markets understand that distinction, and when traders begin treating a shock as structural rather than temporary, prices behave differently. They move less like a reaction, and more like an adjustment to a new reality. That subtle shift in psychology may be one of the most important developments unfolding beneath the surface of today's headlines. And it begins to explain why energy markets are refusing to calm down, even as policymakers attempt to intervene. But here is the subtle detail many investors may be overlooking. Even with the recent pullback, silver around $84 per ounce is still up more than 18% since the beginning of the year. And gold near $5,150 remains historically elevated. In other words, the short-term pressure we are seeing may not necessarily reflect weakness. It may simply reflect a pause while the financial system recalibrates around inflation, energy, and monetary policy. Markets rarely move in straight lines. When the US dollar strengthens and Treasury yields rise, metals often step back temporarily, because the opportunity cost of holding non-yielding assets increases. Yet those same forces can quietly lay the groundwork for the next phase of the cycle. Energy-driven inflation has a long history of reshaping capital flows across the global system. When oil prices surge under geopolitical pressure, as they are now with tensions involving Iran and disruptions across the Gulf, the ripple effects extend outward, into currency markets, into interest rates, and into investor psychology. That is why moments like this often feel confusing at first. Prices may move in ways that seem contradictory, but beneath the surface, the system is simply absorbing new information. And as inflation expectations continue interacting with geopolitical uncertainty, the metals market may still be preparing for a much larger shift, one that has not yet fully appeared on the charts. Which brings us to the next moment the entire financial system is quietly waiting for. In the coming days, investors will be watching the release of the U.S. Personal Consumption Expenditures Index, the PCE report, the inflation measure the Federal Reserve follows most closely when shaping monetary policy. This detail matters more than most headlines suggest. February's Consumer Price Index rose 0.3%, keeping annual inflation near 2.4%, a level that remains above the Fed's official target. As a result, markets have already begun adjusting their expectations. Instead of multiple rate cuts this year, traders are now pricing in only a single potential reduction, a shift that has strengthened the US dollar and pushed Treasury yields higher. But the real question is not just whether inflation is slowing. It is whether the energy shock in the Middle East will push it higher again. Oil markets are tightening, tanker attacks are disrupting supply routes, and institutions like the International Energy Agency are discussing strategic reserve releases. The next inflation reading could carry consequences far beyond a single data release, because sometimes the numbers themselves are less important than what they reveal about the direction of the system. And the next chapter of this story may begin the moment those numbers appear.